Zero. Hey guys, Crypto Sniper here. Update XBT USD. That's the BitNext version. We've been looking at that chart for a bit. I was using it. This is a Snagit snapshot just taken. And so this is how it's been for us. So we did well over here. So the break of the channel is on the blue square, essentially. Let's grab the pen and scribble in one of the colors. Let's leave the pink for now. So that was the break of the channel, and it worked well, and it was a benefit to the upside. This was the top line of that bigger channel where we'd been tapping up against it. As I've mentioned, I think we've covered this in fair detail already, so I won't over-egg that one. That was the move up. That roughly made its geometric target, and then we got a continuation pattern roaming up. I was actually, for those who sometimes say, oh, you never talk about losing trades, I lost here a little bit on the leverage trading. The investment's been great. That red grind line, I kind of ignored it and felt, well, we might melt up out of there, and we might have had a squeeze like that. That didn't happen. So I took a small, very tight loss there on the sell-off and the leg down to this level. I was looking for a more aggressive up. So here's the thing. So we're investment long now, and have been for a bit since the inverted head and shoulder broke and asserted for the second level. So that's from a down here. So we're accumulating fiat at the moment, and we also accumulated some Bitcoin with that move. I gave a little bit back now with that Russian job against the grind line. I felt it might melt up. There was a chance. So there was a possibility that this up leg could be fairly impulsive. The down legs are more moderate, but it could be fairly impulsive. But remember, it's the third. It's a echo to an echo bull to the main bull. So the main bull is your 20k. You got your first echo, which is still a reasonably significant bull, but we're still talking at the super macro level. It's not a bull to a new all-time high. So it was a rally back up after the strong sell-off down to 3.2, and now this is in effect from the 6.6. Remember, we're the ones that called for that target at 6.8, and I can tell you that we're looking for between the 9.5, 10 to the 12k, maybe 12.5 if you're super lucky. That would be your broadest range if I were to scribble. Let's get the pen out the way there. 9.5 to about 12.5, but my guess is slightly tighter. Within that, I'd go 10 to 12 more for a topping out point here in this overall big continuation. So we're continuing to get positive affirmation for our macro continuation, which actually makes these little moves only just part of swings in a big structural macro time frame super continuation pattern that could lead to a very strong bull move to come. Most others have asserted that we'll go to a new high. I'm pretty sure you're going to get people that are going to assert this is a bull run and it's going to run 20k again. They'll be saying that. What they're not understanding technically is that there's just not the same scale of volume and engagement now. That's why we're having smaller ripples. These are the post-earthquake minor tremors that are following the big move up to 20k. So this is still part of the calming these up legs. Many people, I think, are going to be going, yeah, now we're in a bull market through 20k and beyond, and you'll get McAfee and Max Kaiser saying this is the up leg that's going to take you to 30, 50, 100, 2 million, X squillion, etc. And you've got to just take it with a pinch of salt. These aren't specialist chartists, and so we're going to have an up move, but you've got to be prepared to take off at some point. And I'm giving you guidance as to where it was. So let's get off that screenshot and go straight to the actual live chart now, because I can change the time frames on there. So that was what's recently occurred. You can see I didn't finish actually with that. I should have just finished. You can see that I was a bit early, but I wasn't entirely off. In that we did sell down through the grind, but then we did get the continuation, and then boom, you're up. And broadly, I'm looking 9.1, approaching the 9.1 zone, maybe slightly sub, but target should normally just be cleared. So there's a decent chance you make the 9.1. So that'll be guidance. So there'll be a little bit of guidance for you in terms of where we're at. Then again, note these targets the patterns are getting smaller, slightly smaller. So this is another key element to it. So we've had a bull move, but when you start getting structurally smaller patterns and incrementally higher highs, so you've got this target from here, but from here you've got that target. What is actually happening is you are slowly exhausting. Also note volume a little bit lower. So you're going to start squeezing into a rising wedge, which sets up eventually the pause period, maybe somewhere here in the 9s. We haven't made the 9s yet, but in fact maybe you have for a smidgen of a moment. But you get a little bit deeper in the 9s, and then at some point we'll have a rest. I don't think it'll be too crippling. I think generally the pushbacks are going to be moderated. That doesn't mean insignificant. If you're over leveraged long, you're going to get cleaned out. So be careful. But we're building up for at some point a bit of a calming and pullback period. By the way, though, that doesn't mean, and we'll get all the guys that'll come straight on, yeah, you're wrong and all of that. It doesn't mean you don't first do a pop out the top on a rising wedge. So you'll learn, if you do our program, many ways that wedges can roll. Click on the link below, get the free mini series, or book a call if that's what you want to do. Not for everybody, but you'll learn how they roll. And the type 3 option is in fact the type 2 option for the rising wedge. This is the HVF method concept, is a pop out the top. So you don't immediately necessarily go into a breakdown out of a rising wedge. Sometimes you have a final blow or flurry out the top and then come down. That's why it's hard to put an exact level where that high is. It's also grinding higher. So you're getting what I call marginally higher highs. So that's just showing a loss of overall momentum. This is when you're a good technical analyst, you don't need all those maths formula indicators along the bottom to tell you something's losing momentum. If you're a proper pattern and price behavior technical analyst, you don't need some mathematical calculation line crowding out and taking you away from the price, which is only respondent to the price itself. In other words, just a tail to the dog, not new data, to tell you that loss of momentum is occurring. And that's exactly what you get when you get a rising wedge, marginally higher highs until some exhaustion kicks in. So that's pretty much. Then we'll have a bit of a down leg, and then at some point base out, and then you'll be looking, as I've mentioned, you may go all the way to the 10 and possibly top out at the 12k, possibly even the 12.5 if it's a super strong one. We don't know how aggressive the third and final impulse will be. Will it be symmetrical, a little bit high slung, a little bit low slung? We teach you about those phrases and what it means in setups in a program as well. So if you want to find out more, you can go do the necessary. Anyway, so let's have a look overall. Why are we quietly confident and overall bias bull to Bitcoin, both now and in the macro period, exceptionally bullish? Well, because it keeps doing what we expect it to do. As I say, you've seen nobody with these scenarios, only now more recently you're seeing them starting to come. But essentially, if you squeeze this chart down, as you should, this is, and I'm going to log scale it as well, because generally cryptos are exceedingly low slung. You have absolute euphoria blow off highs that when you throw down fibs, you get very deeply slung price behavior, because then you get real toxic butthurt bear market hangovers, and this just slums. So you get extremity to the volatility, and logarithmically it's actually more able for you to see some sense in it, especially now we're getting derived markets coming in on a bigger scale. Actually, it's a separate discussion, but the derived markets are the only place I'm getting liquidity now. I can tell you from exchange trading in exchanges, not a whale, not a big swinging dick hero, but the liquidity just simply isn't there to the same scale. The volume is thinner on the ground. The places to go, I'm having to go, are the derived markets. You're thinking of the BitMEX. I think the future is you're going to see a lot more of that. But you've got to remember that their index is based off the exchanges. So now you're going to end up having more participants in the derived markets. This is taking us exactly to where the traditional, all the same concepts and all the same principles in terms of gold markets, etc., etc. Very few people buying and actually taking delivery out of COMEX and collecting a gold bar. But you have a derived market that is absolutely huge. So, for people who don't understand derivatives, quick explanation. It's kind of like me and George, we both have, this is the medieval times, and we both have fighting cocks, and we decide to bet a fiver, or let's say 5 shillings in medieval England, to have our 2 cocks have a barney on a Friday night. The one who survives wins, the one who dies loses, and then the whole village comes out and selling pints and evenings, and it's a full-on shindig. And instead of just the fiver between me and my mate on whose cock wins the fight, the whole village is betting, and there's a bookie and he's taking bets from everybody, and then it becomes a county-wide thing, and the local mayor's coming in and putting his bid in, and everyone's having a pint, and they're all cheering and getting drunk, and we have an huge audience, and actually hundreds and thousands of shillings are changing hands on the outcome of that match. The prize money for that match is just the 5 shillings between us two, but the overall power of the outcome for betting syndicates and control structures of medieval construct, the local tertiary extractor and manipulator is there, and he comes up to me and offers me £100 to lose, and to feed my fighting cock a bit of a poison pellet so that he's a bit green on the day. That's in essence what goes on. So I lose the fight and make £100 instead of winning 5 shillings, and the game is rigged, and the book is done. And this is the risk you have going in with the derived market. So I took a little tangent there. Apologies for that, but there's a little bit of a learning in that's also valuable for people in terms of understanding the construct of markets and derived markets on underlying markets. This is a phraseology you should be using. When you buy in an exchange, you're buying you're actually buying Bitcoin in an exchange, and you own that Bitcoin. If you trade a certain amount of dollars on a derived market like BitMEX on whether Bitcoin price goes up or not, you're in effect trading a contract of dollars on an outcome on Bitcoin. So you're betting on the cockfighting. You're not you don't own a cock. Okay, I hope you do deep down, but anyway, I mustn't stray from the concept. As a predominantly male channel, but you could transgender like me, which is also, who knows, then we donate our cocks to somebody. Anyway, back to this. So we've got a long-term, super high bull market, and we've got our bear, and then you have the second bull market, and now we've had this graduated channel bear, and we've broken that, and we're heading up. So this keeps walking like a duck. Should I say cock? I don't know. Let's change analogies. The other animals also want to play. So it's walking like a duck. It's quacking like a duck. So we are going to the duck fighting instead of the cockfighting now. And as long as it keeps quacking, I'm going to keep treating it as the duck that it supposedly is. I don't know for sure. I'm seeing feathers. I'm feeling a beak, but who knows? So this is our duck theory, the continuation pattern, and it keeps coming. And we were also theorizing that 6.8 would be a great bottom, and you made the target, a bit of an interesting journey, and you had an absolute low of 6.6, and now you've broken out the channel. This thing is walking and quacking like a duck, and it keeps saying, I'm Donald. Meet me, I'm Donald. So I'm going with it. And as long as we are going with it, we buy as bull on an investment level up to the upside, and we're saying you're not going to supersede that all-time high. And believe me, as I've said, the bull champions and the moon boys are going to come in, and they're going to be too early, just like they were too early here and got it all wrong. Need another color, transgender pink quickly. They were wrong there, and then they were wrong here about it continuing up, and they'll be wrong again here. But we'll get our rally, I suspect. But if it changes, then I accept I'm wrong. I remain humble before the market and accept I'm wrong. It was a duck imposter. Maybe it was a platypus, and I got fooled. Okay, so if it does keep going up, what's the problem? I'm investment long. I'll still be doing great. I won't be trading long, leverage long, so I won't be making quite as much money. But for now, I think it's going to do what we think. So I will look to lighten up on any investments I have. Not investments, apologies, trade. Leverage trade, investment, we're staying long from now on. I am not shorting again. Even with this expected down move that will come out of this roughly 10,000 to 12,500 zone where I'm calling a likely top out, even with the slight soft move, I'll stay investment long. I just won't be trading long, and you'll probably give back a little bit, and that's okay. Don't try short that. You saw how hard it is to make money shorting down this down leg, and this was going to be, by my reckoning, if it's coming to us as we think it is, was a more significant, or should be a more significant down leg channel than that which is about to come here. So you're not easily going to make money, and we got that early call correct, and even still you saw how bumpy a journey it was. So here's what you need to do: you bias investment long and you stay investment long. That's it. You ride it now. This is the time where and I'm not a hodl guy. You know that. We can add value generally if you have real method. There's a time and place for it. This is going to be becoming a quietening market. We're getting compression. The volume is not as high. You're getting compression. Volume will dry up. Volatility will dry up. The ability to make money leverage trading goes down. Lots of patterns will fail. The long ones will fizzle before making targets. The dips to the downside will fizzle before getting the lows. You're going to get compression. It's going to be a bad trading market. This is typically where all the guys go, technical analysis doesn't really work, you know. I told you many times, and and they know nothing. It works when it's supposed to work, and if you're a good technician, you know when to apply it and when not to apply it. If all you have is a hammer, then everything is a nut, and you've got to recognize when it's time to put the hammer down and when it's time to pick it up, and you're going to get to the point where it's hammer down time. But first I'll bias trading long as well here, till we get roughly, as I say, from that 10k to the 12k tap out highs, and then we will go from there. Thereafter I will stay investment long, and I'll eat whatever little come off has to come our way. Now that makes me vulnerable in a sense, because if we had a super down leg at the point that it runs that 6-6 low, I have to say my thesis is wrong. So there's always a point when your thesis is accurate, and at a point, and this is the key with HVF method and how we trade, and if you choose to find your own way of how to trade, good luck to you. Make sure you have a line or a level at which point your thesis no longer holds, so that you say, I'm done and I'm eating that amount of loss and no more. So we are in essence saying we will probably not see what we refer to as this relative low 2 level ever again. So here's your headline for this YouTube clip: never to see $6,400 again, if our synopsis is correct. Because the move that will come out of this huge continuation pattern should take you so far away from it that we are moving into a new level. Kind of like where Amazon now, it's not seeing $100 again, it's not seeing $6 post .com boom again. Just isn't happening unless they do stock splits or the world ends. You've got to be very careful about saying never ever. But here's a headline, say something controversial. We're not seeing the 6-6 lows that you got there again, and that this moderate, calm little move is actually the beginning thereof, and that you'll go there. If we do and it runs out, hypothesis is wrong, and we're okay with that. Then we find a new hypothesis. But as long as it's performing as we expect, we stay and we dance with it as we expect. So it's quacking, it's a duck. We get the duck hunting weapons out. All right. I think that's all I really want to say for now. So still investment long and not expecting to change that. We expect there will be a calming, then it'll be really boring. It's going to be watching paint dry stories. You'll hear that, watch for those tweets, and then boom, out of the blue, you'll start to have some really strong volume coming in, and it'll be driven by events. People say, oh, but you were lucky. Trump did XYZ, or the dollar suddenly went into full repo print, or QE456N, QE Infinity was suddenly announced, UBI for everyone, etc. You just got lucky with your technical analysis. No, those things are baked into the market. You won't be getting lucky. If it comes to you and that's your hypothesis, you modeled for it. If it starts to fizzle, then we're inaccurate and we get out. Okay, so it's actually coming a little quicker than I thought it would. I thought this is something that would probably only happen in and around the electioning period and possibly thereafter. At the current rate, at just about 9,000, you could be at 10 and 12,000 very, very shortly. That doesn't mean you won't top out for a while there and make this nice big and burn up some time. Could make a long tabletop there and then a very moderate easing. Who knows how it will actually go. Lots of time can still be burnt up without a great deal happening, and that's kind of what I expect to happen. How people felt there during this period is what's going to, for me, overall come back. And you note the volume drop and the volatility drop. That's kind of what we're going to have even more of, in my view, until such time as the market tells me different. Then I will change the view. Okay, a lot of repetition in there. I'm not going to say any further. Enjoy. You know how to position. You want to bias long on investment. You want to look for select trading opportunities long. Take no further shorts. In my view, that is what I will do. That's not advice. I'm talking to you as I would talk counsel to myself. I will take no shorts even when there is a downside easing to be had. Not interested in it. You will be regularly spiked. It could be a jittering. A lot of cry wolf markets. When we get to that very quiet period, what could happen? A lot of fake runs on very light volume. Because you're going to be so light volume, it's going to be easy for manipulations. So you're going to get cry wolf. They don't want you. Think of the market as a bucking bronco that's trying to stop you from making the millions. You earn your money by staying on script. And they're going to make it hard for you. In low volatility, low volume markets, you're going to get sudden breakouts. And you're going to FOMO in and chase the spike, fizzle back down, back at the level. Maybe a little dip spike, short. Boom, pumps back up, calm down. You're going to keep getting fake runs. And that's just going to cost you. You're going to burn up your trading account and you're going to get thrashed. You're going to be lose confidence. You're going to have your Bitcoin eaten up, and by the time the actual move comes, you're going to be absolutely fraught, nerves a jangle, and you'll end up missing it because they're going to fake you out countless time. It's going to be a thin volume, a low volatility market. Won't take much for the derived market and exchanges that need a bit of action to push on the exchange and build a big position on the derived markets and then just throw a little bit of money in the underlyings to push it up. So the scope for manipulation will be high. Don't be shaken off the mechanical bull. You've got to stay on here with the full amount of Bitcoin. It's advisory, not to be heavily in the trading game during that period. That's how I'm counseling myself. You can decide what you should do. I am not regulated. Don't listen to me. Okay, so that scenario keeps coming. We're talking ducks and platypuses and all other kinds of animals today. I hope you enjoyed the clip. By the way, book in below if you want to find out more about how we go about technical analysis and the smaller trades within that, and what we may or may not be doing, and other markets as well. And we'll see you on the other side. Enjoy yourself. Play small, not advice. Remember all that, and catch you later. Bye.